Merger arbitrage in announced deals is fundamentally a binary payoff and classification problem. So either the deal fails or goes through.
Hey everyone, and welcome back to Resonance Spotlight. I'm Vincent, and this is a show where we dive into investment strategies, unpack the thinking behind them, and meet the people who bring them to life. Today, we are talking about a strategy that's been around forever, but is suddenly getting a new twist: merger arbitrage, or as some call it, risk arbitrage. Now, this is a strategy that used to be all about gut feeling. People like Bob Rubin, former Goldman Sachs executive and US Treasury Secretary, made their names on it. Guys who were wired into the deal flow, who just had a feel for what would close and what wouldn't. Rubin once said, "It's a matter of feel and judgment, both for the market as a whole and for each individual situation." But what if you could turn the judgment into data? What if you could codify the instinct of a top-tier arbitrager and build a system that trades mergers at scale? That's exactly what today's guest has done. Joining me is Martin Brückner, co-founder and chief investment officer at First Private Investment Management, an independent, globally active quantitative asset manager. Martin leads a team that focuses on a range of data-driven and AI-enhanced investment strategies, with merger arbitrage being a key pillar. With a background that bridges computer science and finance, he's built a systematic approach to a strategy that has long been seen as a domain of human judgment and intuition. Martin, great to have you on the show.
Hi, Vincent. Great to be here. I've been looking forward to this conversation.
So, Martin, let's start with the obvious. So, merger arb has always been this old school discretionary strategy. So, what made you want to take a systematic approach to it?
Yeah, funny that you just brought up Robert Rubin in your intro. That brings back a moment from my early career. In late 99, I was part of Salomon's trainee program, and Rubin, who was then chairman of Citigroup, addressed over 500 of us new associates in a huge auditorium. He made a prescient observation and said something like, "This must be the peak of the market because I've never seen a trainee class this large." And yeah, he was absolutely right. Just a few months later, the dot-com bubble burst and we entered a long bear market. So yes, he's a legend, and his approach to risk back in the 70s and 80s made total sense. To use that experienced trader gut feeling, fill in the blanks where you don't have hard data. Yeah, and that brings me back to your question. Here's what I believe has fundamentally changed. We're now in an era of exponentially growing data, and every prediction problem that isn't n=1 will eventually be handled better with machine learning methods. What I'm trying to say is that while I believe intuition still has its place in one-off situations, when you have actual data to form base probabilities, statistical models should take the lead. And I believe Rubin would actually embrace that evolution. So coming back to your question, our team, being dyed-in-the-wool quants, definitely embraced machine learning, and we're constantly searching for new strategies. Merger arbitrage had been on our radar for quite some time because it's such a great diversifier for any multi-asset portfolio. I think something we just saw confirmed again in 2022 when stocks and bonds fell, or also in March, April this year. So when in the 2010s, we saw the first large-scale real-world success of machine learning outside of finance, particularly in classification tasks like image and speed recognition, then kind of clicked for us. Merger arbitrage in announced deals is fundamentally a binary payoff and classification problem. So either the deal fails or goes through. So it's just like distinguishing between a cat and a dog with image recognition algos. I mean, I remember applying neural networks for return prediction in the late 90s during my computer science classes, and let's just say that wasn't exactly a money printing machine. So yeah, instead of trying to predict outcomes in noisy systems like the broader stock market, we decided to first focus on the simpler problem of predicting binary fundamental outcomes using proven classification algorithms. And I think what made merger arbitrage even more compelling was that we didn't see much competition for alpha from the quant side in the event-driven space. Mainly fairly simple passive-like approaches. So then in the end, our goal became to leverage data and machine learning to capture the merger arb premium and on top add alpha from efficient deal selection. And that's where we started.
Great. Thanks. So for a listener that's not so deep into that topic, how does your process work from deal selection down to execution?
Sure. So it's basically a 4-step process. And let me go through the steps very briefly. Our strategy basically begins with screening all deals from a global liquid universe of officially announced M&A deals. So far, we have excluded emerging markets for the lack of available high-quality data inputs. But we trade all developed markets, which gives us usually more than 500 deals per year to analyze. And then second step, we analyze every pending deal of the investable universe. We apply our machine learning models to forecast deal success probability, then the remaining deal duration till estimated closure, because fundamentally the payout is a time value of money problem. And then we also estimate downside risks and extract expected returns from market pricing. We combine these to calculate an attractiveness score for all the deals in the investable universe and then rank them. And third step, these forecasts, along with risk modeling, feed into portfolio construction and dynamic rebalancing to ensure optimal risk-adjusted returns. Finally, we execute the suggested trades opportunistically, pretty strict price limits, and then get constant daily updates of analysis to enable timely decisions. So in a nutshell, that's the process.
So what makes a deal interesting for you and do you have automatic no-go?
And the main thing we need is high quality of the available data. That's usually the case if it falls within our global developed markets universe, meaning target companies are publicly listed in regions like the US, Europe, Japan, or Australia. We filter only for hard catalyst deals, so no trading based on rumors. And we also exclude proposed deals or those with very low liquidity, such as squeeze-outs or others, and basically to ensure investability and avoid unnecessary risk. So these are often well-known deals, but at the same time, many are also off the beaten track, either because they're outside of the US, which is still the main hunting ground for many of the merger arb managers, or because we're in mid-cap space. A lot of the deals are straightforward, low-risk situations. But we also found alpha in more complex situations in the past, like I remember the Sprint T-Mobile deal where we had a successful position. So in the end, it all comes down to risk-reward. If risk-reward looks favorable based on our numbers, then even a deal with slightly lower success probability or a more complex situation could be included in the portfolio.
So how do you deal with the stuff that's hard to quantify? Things like politics, regulatory risk, CEO comments, so all the stuff that a discretionary manager would lean on.
What we actually found is that nowadays there's plenty of objective and hard data that can predict the success rate of announced merger outcomes. So if you think about it in the dimension of regulatory risk, for example, we look at the same hard data that the regulators do. So company size, market shares, and market concentration, revenue, profit figures, and so on. So we also look at whether this is a cross-border deal and how many regulatory bodies are involved to quantify regulatory risk. Or another example, risk from shareholder opposition can be quantified through announcement stock price reaction of the acquirer shares, as well as news analysis, news sentiment, or minimum acceptance thresholds, among others. So there are plenty of quantifiable data points out there. In the end, we take dozens of quant input features into account that proxy for those qualitative concerns. Might even allow us to identify patterns and non-linear interaction effects that might escape a human analyst. In recent years, research into extracting qualitative information with the help of LLM technologies also has yielded results. The ML models nowadays designed to process and analyze complex unstructured data from various sources, including news, regulatory filings, which often contain the mentioned qualitative information. So these models consider macroeconomic factors, regulatory requirements, geopolitical aspects, basically allowing us to quantify and incorporate these elements into our probability and risk estimations. But yeah, as a last step in our process, human portfolio managers still provide some qualitative oversight, assessing if specific aspects are not fully captured by the algorithm. And PMs have the ability to mitigate these risks by reducing or canceling positions.
So, right. In that context, you've mentioned that traditional allocators are still a bit skeptical about systematic merger up. So what do you think that is?
Yeah, as you mentioned in the intro, skepticism often stems from the perception that merger arbitrage is a gut feel game best handled by specialists due to its inherent complexities and the potential for left tail risk from deal failure. And we address this by highlighting our superior Sharpe ratio compared to active and passive indexes, demonstrating that our AI-driven systematic approach effectively quantifies and manages these risks. Yeah, another thing we hear the argument that maybe the most alpha or best risk reward nowadays is to be found in off the beaten track complex situations. Because merge up is a well-known strategy, maybe you have to go to the more complex situations. And those obviously seem ideally suited for the deep expertise of discretionary managers. For non-quants, it's usually not obvious how one can quantify regulatory risk and other deal risks before we explain it to them, like we just covered in the question before.
Mm-hmm. So related to that, many systematic strategy in this space haven't delivered great results. So what's different about your approach?
Yeah, in the past, systematic merger up usually meant a passive approach of quite simple screening and basically investing in all announced deals weighted by market cap. Performance of these approaches did not keep pace even with the average discretionary managers, unlike in other asset classes where passive usually beats active. So those passive approaches that I've seen or are still around, they don't have active deal selection. They pretty much invest in every deal, market cap weighted, just like any S&P 500 index ETF does with stocks. So they don't pay attention to the rate of return or risk offered in any deal. Often they only do cash deals. So when they do stock deals, they don't have the capabilities to put on the right hedge in form of single stock shorts. So they might use index derivatives as proxy hedges. And obviously, sometimes those are poor hedges. And also, like most passive strategies, trade execution is probably quite agnostic to price levels. So our approach is quite different to those passive systematic approaches. We emphasize active deal selection, risk management, and portfolio construction not based on market cap, risk reward. And to do this, we leverage patterns from a proprietary database of over 20,000 deals spanning 4 decades. We aim to capture the merger up risk premium plus alpha through deal selection, which actively predicts and avoids the problematic deals. I mean, the track record of discretionary managers of the past decades show that merger up is a fertile space for active management, unlike most other asset classes. So our track record going back to 2017 consistently shows robust outperformance and significantly higher risk-adjusted returns compared to passive indexes like the S&P Merger Arbitrage Index, for example.
And do you think your model adjusts well to shift in the market environment? Let's say when interest rate rise or spread widen unexpectedly?
Yeah, I mean, our models are fully dynamic, continually incorporating new information, updating forecasts for all relevant deal parameters. So we typically use exponential weighting schemes that weight new information more heavily, but we also identify regimes, use information based on different macro or regulatory regimes like Trump and Biden administration changes. So we explicitly analyze factors such as macroeconomic conditions, regulatory environment, geopolitical aspects, allowing the algos to adjust their predictions based on the prevailing environment. For instance, rising rates tend to widen arbitrage spreads, making the strategy more attractive. And our models are designed to capture these shifting dynamics. Let's take example of US deal, very recent example. The market implied probability for the deal closing was not very high. I mean, the stock still traded in the mid to high 30s at the beginning of the year for $55 cash offer from Nippon Steel. And with fundamental downside in the stock, maybe to around $30. And that was already after the US administration change, who opposed the deal under the Biden administration. But I mean, in January, our models had already adopted to the new regulatory regime change from Biden to Trump and saw this as a pretty good risk return trade. And yeah, I think we made more than 30% by the time the deal closed successfully just this week.
Right. And if I line up your model next to a discretionary manager, someone who's been doing this by gut for 20 years, where do you think your system has an edge?
I think that the operational processes of discretionary managers lead to some inherent weaknesses that a systematic approach can exploit. I mean, for example, discretionary managers relies on manual analysis of a limited number of deals. I mean, that can lead to slow decision-making and suboptimal diversification. I mean, what I mean is the significant exposure to idiosyncratic risk of individual deals. I mean, it's not unusual to see 10% plus positions in one deal for these managers. So manager risk is usually much higher with a discretionary manager. And as an allocator, you might get the allocation to merger up right and the generic merger up risk premium might deliver. But because one deal with a high weighting in a concentrated portfolio of your manager blows up, then you don't capture that performance. So apart from diversification benefits, we also find some of the most interesting deals on a standalone basis in regions outside the US. So, for example, in countries where there's maybe one interesting deal only every 2 or 3 years, for the bigger discretionary funds, they might not hold available the legal expertise for that reason. So if this deal comes up, they're not really quick to capture, or they might ignore it also. So for us, our global investment universe is crucial as it avoids sole dependence on any single market. And we can always build diversified portfolios of 40 or more deals. So for example, during periods of stricter antitrust stance in the US, during the Biden years, when a lot of discretionary US-based managers struggled a bit, our exposure to Europe and Asia Pacific provided quite stable returns.
All right. So that all sounds great in theory, but can you give an example of a specific deal where the model picked something up that most people will have ignored?
Yeah, I think in most cases, the risk reward in merger deals is asymmetric. I believe it's actually more important to avoid important deals that fail rather than find overlooked deals that go through. In general, 80 to 90% deals close successfully. So it's a bit like corporate credit investing where you have to win by not losing. That basically means avoiding bankruptcies in that case, or in our case, failed deals where price can easily drop 30 to 50%. Notable recent example would be Capri Holdings. It's the company that owns Michael Kors, Jimmy Choo brands, and was to be taken over by Tapestry. That deal failed in 2024, sending Capri shares down 50%. So to my knowledge, many investors suffered significant losses on this deal failure, which came due to FTC intervention. And our approach was able to identify and avoid this particular risk, preventing a drawdown for our portfolio. I mean, in this case, in addition to our deal success probabilities, was the modeling of the downside risks in case of deal failure, which we do by dynamically identifying peer groups, which showed that the downside risks that had opened up over time, mainly by the negative performance of the luxury peer group, made the deal quite unattractive from a risk-reward perspective. So we were never in that deal and fortunately didn't have to suffer that drawdown.
So when we talk about machine learning and quant strategy, and one thing, you often hear from investor is concern around transparency. Investor will get nervous around black boxes. So how do you explain your approach to allocators who really want to understand what's going on under the hood?
Yeah, I think that's a common concern with quants and obviously machine learning even more. And despite the complexity of some of our machine learning models, we're committed to transparency. Firstly, we follow a strict systematic process. And at the stage of qualitative overlay, PMs can only reduce positions for risk reasons, but not add any personal favorites. And we also provide detailed analysis and performance attribution that explains how our portfolio is created. And we also welcome on-site due diligence where people can actually have a look at our systems and even the code if they want to. Yeah. So I feel when it comes to transparency, we're actually ahead of the discretionary competition. For every change in our investment process, the effect can be demonstrated to our investors with their performance implications. For instance, if you implement a change for ESG or liquidity filters, we can run the numbers and show the precise impact on returns this would have had in the past. So to ensure transparency around feature importance, we also run easily interpretable models alongside our more complex ones. We take an ensemble approach and essentially a mixture of experts methodology where we combine straightforward logistic regression models, for example, that offer complete transparency into all the drivers and run that alongside more sophisticated nonlinear models. The methodology and the process basically dynamically reweights based on each model's success rate. So if the complex models would start underperforming, we would automatically fall back to the simpler, more interpretable approaches. For this process, we don't feel that black box topic is really a hindrance to investing.
So is there still a human in the loop somewhere in your process? Is it fully hands off, once the signals are live?
No, human oversight remains absolutely crucial, integral to our process. Despite the algorithmic core, the PM team on that strategy brings more than 25 years of combined experience in merger arb, and that expertise still plays several critical roles. So firstly, we're constantly monitoring data quality. Algorithms in the end are only as good as the data they consume. So human judgment is essential in identifying when something doesn't look right. Second, our portfolio managers are responsible for identifying gaps in the process through continuous feedback cycles. And they're particularly adept at spotting new risk factor themes that emerge. So, for example, they identified concentration risks in reverse mergers when they were frequent, I think it was almost 10 years ago. Or they recognized when US-China semiconductor deals became particularly vulnerable during periods of geopolitical tensions. So while our core investment decisions are algorithmically driven, portfolio managers analyze specific aspects of deals that might not be flagged by our models. And so they have the authority to overrule the algo's inclusion decisions and can reduce or completely cancel position sizes. But only when they identify risks that the models haven't captured. And finally, I want to add there's a critical area of trade execution implementation. So even when the algorithm determines what to buy and what size, human judgment often drives the timing and the methodology of how we actually execute those trades in the market. So in the end, it's this combination of systematic process with experienced oversight that we believe enhances our edge.
And zooming out, Martin, do you think systematic and discretionary merger arbitrage can coexist? Or is one going to win out over time?
Good question. Since inception, we delivered a better Sharpe ratio than the HFRI merger arb index, which is predominantly discretionary managers, to my knowledge. We have done this with a correlation of just 0.5 and with the index, which shows the uniqueness of our approach. So if you're bullish on merger arb as an asset class and want to capture those risk premia without taking a lot of manager-specific risk, I think our active systematic approach offers a compelling solution. But that said, there's undeniably professional expertise at some discretionary shops. Their performance track records speak for themselves. So I absolutely see room for both styles. In fact, for constructing a top-tier merger arb portfolio, I would suggest finding the best discretionary merger arb manager if you have the capabilities to conduct that due diligence, and then adding our systematic strategy. With just two managers in low pairwise correlation, you would have an exceptional merger arb allocation, I think. And from an allocator's perspective, this provides great diversification today. Though I suspect that at some point in the future, maybe the distinction between quant and fundamental approaches will fade a bit, at least among the most sophisticated investors. I mean, LLMs are leveling the playing field. They're broadening the depth available to quants by helping quantify qualitative factors, while simultaneously expanding the reach of discretionary managers by basically enabling them to apply their insights faster and also across much larger universe, I would say.
Right. So it feels like what you're doing isn't about removing judgment, it's about reframing it, making it consistent, scalable, and hopefully more repeatable. So Martin, if you were talking to skeptical allocators, someone who still believes merger arb is all about instinct and phone calls, what would you tell them?
Yeah, my advice would be this. So while human intuition absolutely has its place, and I said I respect the skill of top discretionary managers, I think modern data science can systematically uncover hidden patterns and predict deal outcomes with remarkable accuracy, as we have seen. And that significantly enhances risk-adjusted returns and provides true diversification beyond what gut feel alone can achieve. I mean, I understand the historical perspective, but what we've discovered is that there are quantifiable patterns in deal outcomes that even the most experienced traders and legal experts might miss. I mean, patterns in regulatory approval timelines, antitrust concerns, financing structures, market volatility impacts. I mean, there are countless other variables that interact in complex ways. Quant, unless it's high frequency trading, maybe, it's not about completely eliminating the human, of course. It's about leveraging technology to make better informed decisions more systematically, I would say. The key for me is that we can transform merger arb from what's often perceived as a concentrated collection of idiosyncratic bets into a stable, uncorrelated, and efficient source of alpha for institutional portfolios.
Martin, thanks again for coming on the show. It's been a great conversation. Systematic merger arb might not have the mystique of Bob Rubin's heyday, but it's clearly come a long way, and your process shows there's real edge in bringing structure to what used to be pure intuition.
Yeah, thanks for having me, Vincent.
And to our listener, if you found this episode valuable, consider leaving a review. It helps us continue bringing you in-depth conversation on investment strategies. For more insight and update, visit us at resonancecapital.com. Until next time, I'm Vincent. Thanks for listening.